Today we're going to talk about cash flow hedging results analytics. And with cash flow hedging, a little bit different than balance sheet hedging, often gets allocated to business units or geographies, more so than balance sheet, and so has a different audience and there's different information that is typically desired from that audience. So first of all, with cash flow hedging, a bit of a misnomer that the Financial Accounting Standards Board gave decades ago. Most folks often are really doing income statement hedging when they're talking about cash flow hedging. Some folks will do an entire cash flow hedge that covers both the income statement and the balance sheet, but for this example we're just going to talk about one that goes to the income statement date or to the revenue or expense date versus the revenue or the receivable or payables date. So if you have one that goes the whole way, you may have a de-designation from a cash flow hedge to a balance sheet at the end, and that's fine. We're just talking about that first part. And in this example, I'm going to assume a layered hedging strategy, which a lot of folks often have. And I'm also going to assume that you don't get to 100% hedge. Again, pretty common as folks don't want to risk over-hedging and losing their hedge accounting treatment. So an example that I'm going to give, I have a generic 80-60-40-20 layered approach for 4 quarters. So at any given quarter, as you roll off from the previous quarter's hedge, you're going to have to top the next 4 quarters off with a 20% hedge for each quarter. So the upcoming quarter, the closest you ever get, or the highest hedge percent you ever get, is 80%. So with this example, I'm then going to give a Canadian dollar example and show the net business impact for the pre and post hedge basis. And what we want to show here is really something that's going to be useful for the company and bridging the gap back to the planning rate or the budget rate that the company has. So just about every company will have an annual plan, and you'll set a line in the sand at the beginning, a month or 2 before each year, and say, okay, these are the rates that we're going to use for that plan. Hopefully you're having some thought put into those rates, and it's not just the spot rate at that time. If you actually have hedges outstanding, the best thing to do is to take the weighted average of the hedges that you already have in place and the best guess for the remaining hedges, which would be either your spot rate or your average forward rate over those periods. So once you have that in place, it's really just your best guess at that period, and there's going to be changes along the way. So even better, if you can change that planning rate quarterly and more closely follow your hedging cadence, that's even better. So we've talked to people about being able to build a bridge back to an updated planning rate, if that's something you can do internally, have Treasury work with FP&A and change the metrics each quarter. If there's whatever the main metrics that the company have that folks are going to be held to or accountable for, that's the rates that we want to track. So in this instance, again, 80-60-40-20 approach. And if we go to the slide here, you can see the cash flow results analytics, and I'm going to go through a Canadian dollar example where the dominant exposure is an expense, Canadian dollar expense. So in this example, I've got this A versus P impact, or accounting versus planning rate impact. And you can see that my expense at the planning rate is a little under 18 million, but my actual expense at the accounting rate is almost 18.5 million, so I had a bit of a headwind. I had worse accounting rates than the planning rate. So the headwind was about 554,000 and change. And if I look at my hedging that offset that partially, I have 446,000 and change of hedging gains to offset that. So my net impact for the company is a little over $107,000 loss. And then I want to explain, all right, where's that $107,000 coming from? And there's either going to be volume drivers or rate drivers that influence that amount. And first of all, the volume drivers actually account for more than 100% of that. You can see those are 137,000 loss. And that's broken down into 2 pieces. Part of it is the volume miss from the policy itself. So if we're only hedging 80%, you wouldn't expect a complete offset. And that missing 20% hedge, in this case, cost us about $104,000. Then the forecast itself was not perfect, so we have forecast deviation. The forecast must have been low since the hedges were at gains. So by not having a perfect forecast, we have additional impacts of about a $33,000 loss from that. And then finally, the rate driver, that's going to be the difference between our planning rate or budget rate and our actual hedged rate. So hopefully early in the year, those two are pretty closely in sync. But if you only have one single budget rate for the year, those are probably going to get further disconnected further out into the year. So if I switch to the next slide, you can see some of the same data for the Canadian dollar, a little bit more detail with the rate. You can see the actual planning rate and the hedge rate, where the hedge rate is slightly higher than the planning rate. For Canadian dollar expense hedging, that's actually a little bit better. So that's where we get the favorable rate impact. And you can see this graphically where you see your different rates on the right side and some analytics below to show this information. So being able to see this information for every currency combination, every entity combination, especially if you're allocating these gains and losses back to the businesses, is crucial in having everyone at the company understand and be more involved in the FX hedging. So if they're just allocated a loss without an explanation of how they're dealing with a currency tailwind offsetting that loss, then they may question the whole hedging practice or strategy. Whereas if you break it down this way, then everyone can understand all the components and all the sources of variance, and you can have a discussion about, well, is 80% the right target? Why was this forecast so bad? Are we hedging, if we're hedging at a rate dramatically different than the planning rate or the budget rate, should we update the budget rate throughout the year, put some threshold on it if it moves more than a few percent? Because no one wants to go through the whole planning exercise, but is there an easy way to layer that into the metrics for the company? The more you can have this type of analysis to kind of be the starting point for those discussions, the more success you'll have in getting a successful cash flow hedging program at your company.